Hello everyone, welcome to another section of the Forex Beginners course. In this section, we are going to be discussing types of price patterns, and I'm going to be showing you how they look on various charts. So first of all, what is price pattern? Price pattern are easily recognizable patterns in the market which can be used to predict future market behavior. I already told you that the main aim of technical analysis is to predict future price behavior, where price is likely going to go in the market. So that is the our aim for doing technical analysis. And in technical analysis, we are going to be using price patterns to determine future price movement. So various types of price patterns that we have more than all this, but these are some of the major ones that we are going to be using the most in this market. So you can go out there and search for more if you like, or you can go out there and hear that there are more than this. Of course there are more than this, but these are the major ones that we have. And just like the candlesticks that I explained earlier in the previous section, sometimes it is not about just the price pattern appearing anywhere in the market. It is about the area they appear in. So that is where you are going to be taking your decision. You're not just going to be using them in just anywhere they appear in. Once they appear in a particular area, then that is when you take action. So number one, number two is descending channel. Number three is expanding triangle. Number four is rising and falling wedge. Number five is bull and bear flag. And number six is head and shoulder, then inverse head and shoulder also. Then number seven is double top or double bottom. So let me show you some of them. So this is how ascending channel looks like. This is how you are going to be seeing it on the chart. So this is like a model of how ascending channel look like. You can see it's moved up, then down, then it keeps moving up as the price is going. The progression is moving up, and you can see this line here, this line that is used to encase the price movement. It is just a framework, so that is why it is an ascending channel. I'm going to be showing you on the live chart too. So the second one is descending channel. Descending channel is just like the opposite of ascending channel. In ascending channel, it is mostly when price is moving upward, and descending channel, it is when price is moving downwards. That is when it is bearish. But in this ascending channel, it is when price is bullish, when it is moving upward. So rising wedge look like something similar to ascending channel, but the major difference is that in rising wedge, once the price where the correction starts, it is going to get narrower as price progresses. That is, it is going to be tighter as price progresses at the end. Here you can see from where it started, here from where the line started, it was wide a bit. Then as price progresses, then it got narrower. That is rising wedge. Then falling wedge also, it is just the opposite of rising wedge. Rising wedge occurs when price is moving upward, and then falling wedge occurs when price is moving downward. Just like I explained before, also in falling wedge, price is a bit wide at the beginning of the correction. Then as price progresses downward, it gets narrower. So that is falling wedge. Then the other one is expanding triangle. Expanding triangle. In expanding triangle, it is just like the opposite of rising and falling wedge. But in this case, the correction starts a bit narrow. Then as price progresses, it expands and gets bigger. That is why it is called expanding triangle. In some cases, they may call it symmetrical triangle. It's also the same. So in expanding triangle, price is first narrow at the beginning of the correction, then it expands as price progresses. That is expanding triangle. The next one is bull flag. Just as the name goes, bull. It is a type of flag that you use to make entry when you are about to buy a pair, when you're about to long a pair. As you already know, the same long means to buy. So when you say you are longing a pair, it means you are buying the pair. So the main purpose of bull flag is where a market is about to buy. So when you see a bull flag, it's a type of entry that you can use to take a bullish movement. So this is how a bull flag looks like. Bear flag is just the opposite of bull flag. It is mainly used to catch an entry in a bearish market. So this is how the bear flag looks like. Price is coming from a higher position, then it corrects or consolidates before continuing downwards. So that correction is what we call bear flag. So the main difference between bull and bear flag is that bull flag is mainly used to catch an uptrend, and a bear flag is mainly used to catch a downtrend. Head and shoulders. This type of price pattern, it has like the human body. We have one head and two shoulders. So that is how head and shoulders also look like on the forex market, but it's a bit different in that here we use candlesticks. So when price break in head and shoulders, when price breaks upwards, it corrects, then moves up very well with heavy momentum, then comes back downward and then creates another correction, then moves in the opposite direction again. So that is how heads and shoulders look like. I'm going to be showing you in a live chart so you'll be able to understand very well. So inverse head and shoulders, it is just like the inverse of head and shoulders, like the name suggests. So the opposite of head and shoulders is inverse head and shoulders. So in the inverse head and shoulder, you can see the left shoulder here, the head, then the right shoulder. So that is inverse head and shoulder. I'm going to be showing you on the live market too. And you can also, after I show you, you can also go on the chart and also check for yourself to be able to identify all these patterns. So just like candlestick formation, the area of formation in price patterns is also very important in making decisions in the market. I already said this before. When I was explaining candlestick formation, I told you that it is not about the candles forming alone. It is about the particular area where they are formed. So in price patterns also, we need to take measure and we need to take into consideration the particular area where price is forming. So that is where we are going to be making our decision. And in this forex market, you need to be making quality decision to make a lot of profit. So live example of price patterns and how to use trading view. So now I'll be showing you some live examples of the price patterns I just mentioned, and I'll be teaching you how to use trading view also. So here is as an ascending channel. This is what it looks like. You can see. For you to see it properly, this is what an ascending channel looks like. You can see price is coming from a higher place, then this is a low, then this is a higher high, then a higher low, then a higher high, then a higher low, then a higher high. So that is what makes an ascending channel, and price progresses upwards in an ascending channel. So let's go to the next one. So this is a descending channel. Let me go to the lower time frame so you can see it very well. Sorry about that. So this is what a descending channel looks like. So it is just the opposite of an ascending channel. You can see as price progresses, it is going downward. This is a low. You know, in a bearish market, it is coming downward, so it's a low. Then this is a lower low, a lower high, a lower low, a lower high, then a lower low. Then price is also progressing downward. So this is what a descending channel looks like. This is also another example of descending channel, as you can see here. Let's go to the next one. Rising wedge. Like I explained earlier, in rising wedge, price is coming from a wide area, then as it progresses upwards, then it gets narrower. You can see it's a bit wide here, then as price is progressing upwards, it is getting narrower. Let me the opposite is falling wedge. If you flip this chart, then you are going to get falling wedge, because the opposite is of rising wedge is falling wedge. As in rising wedge, as it is progressing upward, it is getting narrower, and in falling wedge, as it is progressing downwards, it is getting narrower also. So let's move to the next one. Then expanding triangle. You can see it's the opposite of the wedges that I explained earlier. So as price is progressing, it is expanding, it is getting wider. It is a bit narrow here, then as it is progressing, it is expanding. Look at the other example too. It is a bit narrow here, and as price is progressing, it is expanding. So that is why we call it expanding triangle. Let us move to the next one. Yeah, bull flag. You can see this. I told you bull flag is used to catch an entry in a bullish market, and I told you that bullish market is a type of market that is trending upward. So you can see as price is progressing upward here, then there's an appearance of a bull flag here, and as the bull flag, you can set your entry and you catch this impulse upward. So that is one of the uses of a bull flag. So this is how a bull flag looks like. This is a bull flag. Let me show you another one. This is also another example of a bull flag. You can see that as price move a bit upward, it forms a correction, and it is used to catch a movement upward. So this is another example of a bull flag. Let's go to the next example, which is a bear flag. Just like the opposite of a bull flag, the bear flag is used to catch an entry in a bearish market. So this is what a bear flag looks like. So you can set your entry for you to catch the impulse downward. Then let's go to the next one. So double bottom, double bottom. If you look closely, there's an anchor point here. So price already bought from this place. So when price bought from this place, it moved upward, then it came back down, back to that bottom. So which makes it a double bottom. So and in this double bottom, what happens most of the time is that when price comes back to tap into that bottom, it reverses and continues upward. So that's one of the main uses of a double bottom. So I'm going to be when I'm teaching you technical analysis, where I'm going to be teaching you how to use this particular area, what you can look forward to catch the impulse upward. So this is an example of a double bottom. For example, this bottom also, there's another bottom here. So let's say price comes and then taps into this lower bottom, it can also buy. But for now, price has tapped into this other bottom and it has started buying. So there are things you can look at in this area for you to catch this movement to the upside. I'm going to be teaching you when we are talking about technical analysis. Let us move to the next one. So this is double top, just like the opposite of what I talked about earlier. So this double top, there's an anchor point here. So price already sold and came down from that point and then came back up to tap that top. I'm going to be telling you the reason why it breaks upward before coming back downward. I'm going to be telling you one of the advantages of this, of it breaking this top to the upside before coming back downward. So that is double top. Then let's move to the next one, which is heads and shoulders. I'm going to be using the head and shoulder tool to make this clearer for you. Head and shoulder. So that is it. This is the left shoulder, this is the head, and this is the right shoulder. So in the forex market, the market can be ugly at times. So both shoulders might not be equal to each other, but there is a high probability that the setup might play out if they are equal to each other, or the right shoulder is higher than the left shoulder. But like in this case, it is not higher than the left shoulder, but it is an example of a head and shoulder pattern. So those are examples of price patterns. And in when I'm talking to you about technical analysis, we are going to be I'm going to be teaching you how you can use these patterns to predict future price movement, how you can use the ascending channel with the double top or double bottom, and when price gives you a momentum, how you can use the bull and bear flag to enter the chart, the advantages of where rising and falling wedge. So I'm going to be teaching you all those. So in the next section, like I've said before, I'm going to be teaching you how to use trading view, and we are going to dive deep into technical analysis. So thank you and watch out for the next section.